Howdy folks, and welcome to our second seminar in oil and gas accounting. This one will center around depletion and impairment for both full cost and successful efforts. While most of this will be centered around oil and gas, this could be applied to most natural resources that incur depletion. In our next episode, we'll be talking about asset retirement obligations, or ARO. It's a detailed calculation, so stay tuned. If you learned something new, please like, share, and subscribe.
So to get started, let's kind of talk through the agenda. So we're going to discuss the audit risks surrounding depletion and impairment, and then we're going to do a high-level review of full cost accounting method and the implications that affect the depletion and impairment calcs. Then we're going to do a bit of a deep dive into depletion and all the different components of the calculation. Then what better way to instill the learning than to get your hands dirty? So we're going to do some exercises. We're going to work through depletion. Then we're going to talk about impairment and the ceiling test and then do an exercise there. And then any questions y'all have, feel free to toss them in the Q&A section. And then we have a designated slide at the end to talk through any of those. Okay, so for your audit risk, things that you want to keep in mind when you're auditing these sections is that depletion and impairment are typically the largest expense line items on the P&L. Completeness and accuracy of these computations are dependent upon controls and various other processes. Some of the supporting processes represent significant accounting estimates that are very highly subjective. So a lot of your reserve report estimates are what drives these calculations. So there's a lot of moving parts to consider before you even get to the point of calculating depletion and impairment. These computations are subject to various rules that the preparer needs to be aware of, and the computation itself is an estimate subject to error or fraud. So we have to be highly aware of that when we're auditing these calculations. So a high-level review. So with full cost accounting method, generally all costs are capitalized and considered necessary for the ultimate production of reserves. So you have a couple different categories: your acquisition costs, exploration costs, development costs, and these are all considered to be capitalizable costs. Production and workover costs are expensed as incurred, so these would fall under the LOE category and not capitalized and subject to depletion. Companies expect that benefits obtained from successful prospects in a given cost center will be adequate to cover costs and yield a profit. These costs are grouped by cost center, which represent an aggregation of individual oil and gas wells, typically by country. There's also some subsequent measurement considerations that we'll talk about here in a bit. So keep that in mind. If your company's full cost and you're looking at these calcs, you only need one reserve report. Okay, depletion. Let's get into it. So here's the calculation, high level. Oil and gas property costs are amortized using a unit of production method for each cost center. Cost center, again, is by country. So for full cost, generally, a lot of our clients are all in the U.S. So every cost associated with any well in the U.S. is grouped in a cost center and depleted together. The first aspect of this calculation is you need to figure out what the depletion rate is. The depletion rate is calculated by taking the current year production, so all the reserves that the company pulled out for that year or that period, divided by the reserves that they expected to get at the beginning of the period. We'll get into that a little bit later. Once you get that depletion rate, you multiply that by the depletable base. Depletable base, high level, is all your capitalized costs, net of accumulated DD&A. Multiplying those two factors together give you your depletion expense. So consider this for a moment. At what point does the company need to start booking depletion expense? They need to start booking depletion expense as soon as they are producing commodity out of the ground. Because if you think about it, that's when that reservoir, those reserves are getting extracted. That's when the reserves are getting depleted. So the company needs to be booking depletion expense. Now, If oil and gas are found together, amortization per unit generally should be calculated on the basis of the estimated total equivalent units. We're going to get into that calculation in a little bit, but high level what that means is if you've got oil that's in the denomination of barrel and you've got gas that's in the denomination of MCF, you've got to get them in the same equivalent unit to be able to deplete them together. So you do not deplete oil separately from gas. They're depleted and included in your production number and your beginning of period reserves together. So you've got to get them in the same unit. That equivalent unit is either going to be a BOE, barrel of oil equivalent, or an MCFE. Unit of production rates are revised whenever the need is indicated, but must be reviewed at least once a year. So every company has got to calculate depletion at least once a year.
If there's a significant acquisition or a significant disposal, that is going to manipulate the pool that you're depleting significantly. You evaluate, and if it is significant, then that's could trigger a need to revise the depletion rate, the unit of production rate. Public companies or issuers generally perform quarterly calculations. So issuers are performing these quarterly, and private companies, non-issuers, are performing one annual calculation. So private companies only have to do it once a year, but they can do it quarterly if they want to. Public companies have to do it quarterly, however. For an issuer's calculation, you use quarterly production and beginning of period or quarter reserves. So in that first calculation of the depletion rate, you're going to have, say this is Q3's calc. You're going to have all the production from Q3 divided by the reserves that were estimated at the beginning of Q3. So it can be for the period, or for private companies, it'll be annually. So non-issuers, you use the annual production in the beginning of the year reserves. Example, your production for the depletion rate is going to be all of 2021 from January to December production. Then your denominator for your beginning of period reserves is going to be what they estimated at the beginning of the year. So if we audit them year over year, we look at, okay, if I'm doing 2021's depletion calc, I need to look at 12/31/2020's reserves estimation to factor into my depletion for the current year. Okay, so now we're going to do a bit of a deep dive into these components, you guys. So depletion rate, which again is here. Depletion rate, we're going to go into the beginning of period reserves, and then we're going to get into the depletable base. So first up, depletion rate. This includes only proved reserves, okay?
On the different categories of reserves, there's generally 3 different proved, right? You've got your PDPs, developed producing proved properties, PDNPs, and you've got your PUDs. You can look back at those other slides to kind of refresh your memory on that. But for this depletion calc, we're only talking about proved reserves here. The unproved, we're not concerned. So proved reserves are reasonably certain, where the company is reasonably certain that reserves can be recovered under existing economic and operating conditions. So these have been proved up. The company's gone out there, they've done their research, they know that there's reserves in the ground. That's the reserves we care to factor in here. Now, you should be including, like I said, both developed and undeveloped reserves. So PDPs that are currently producing, PDNPs that are not producing at the moment, but they have produced before. So maybe they're shut in. Like when everything went nuts in 2020, they shut in some wells to try to, save some money and wait for their cash flows to get a little bit better before they produced again out of some of these wells. PUDs, these are undeveloped or not completed. So they're in the process. The company knows that there's reserves in the ground, but they're in the process of being developed. All 3 of these categories need to be considered. Now, they're estimated under SEC guidelines, which we're not going to get into, but there's guidelines that tell you how you should classify different reserves. Okay, the component of the depletion rate beginning of period reserves. So as reserves are usually estimated at the end of the period, so the company at the end of every year, they say, all right, let's gather all of our data and let's figure out what we think our future projections starting in 2022 on are going to be. They do that every year. The current period production volume, or the units sold, is added to the reserve volume at the end of the period to determine the beginning. So that's how you get to that component of the calculation, is you have to add in the current period production and add that to what you're seeing at the end of the year to get the beginning. Now, shrinkage, if significant, should be applied consistently on units sold and reserve base. Either both are before shrinkage or both are after. You got to compare apples to apples with this. So these reserve estimates, they may be performed internally by the company's reserve engineers, or they may be performed internally and then sent off and audited by an external engineer firm based on the standards pertaining to estimating and auditing of oil and gas reserve information by the Society of Petroleum Engineers. So if it's a private company, they could be doing it internally, but generally all companies gather the data internally, put together a preliminary reserve report, and then send that off to a third-party expert to give their sign-off on it. Okay, so let's get into the conversion to equivalent units. So this is the situation where you've got oil, you've got gas, and there's other NGLs, so on and so forth. But for now, we're just going to pretend there's oil and there's gas. So we've got barrels of oil, MCFs of gas. We need to figure out which unit is the most significant, which one is dominant. The rule of thumb here, which is very important, is 1 barrel of oil contains 6 times as much energy as 1,000 cubic feet of gas. So there's your equivalent unit there. Here's an example. Production is 4,000 barrels of oil and 6,000 MCF of gas. Show the conversion to equivalent units. So offhand, it looks like we have more MCFs of gas than we do barrels of oil, but we need to convert those MCFs of gas to a BOE, barrel of oil equivalent, before we can compare apples to apples. Or vice versa. It looks like we have less barrels of oil than we have MCFs of gas, so perhaps MCF of gas is the dominant unit. We would know that by converting the barrels to MCFE. Now, how do we put that into practice? We would take this, if we're doing a calculation to determine if the dominant unit is BOE, we would take the barrels of oil, 4,000 barrels, add into that 6,000 MCFs divided by 6. So there's 6 times as much energy in an MCF for gas than a barrel of oil, okay? So you have to divide that by 6, which gives you a total of 5,000 BOE. So you have 1,000 BOE of gas plus the 4,000 barrels of oil gives you a total of 5,000 BOE. Now flip that. If we take the 6,000 MCFs, we need to multiply the barrels of oil times 6. So going back to algebra days, which gives us 30,000 MCFE of gas equivalent. Okay, so since oil is the dominant quantity after conversion, so if you look at how many barrels of oil there was compared to how many BOE of gas there was, which was 1,000, then you see that BOE is the dominant unit. So we need to stick with the first calculation, which converts the gas MCF to BOE. And then we're going to do our depletion calc all based in BOE. So for your production and your beginning of period reserves that factor into the depletion rate, they're all going to be in BOE. So before you even get to that point, you need to take all of your gas volumes and convert them to BOE. Okay, Now we're going to talk about the depletable base. We just talked about the depletion rate and the different components there. Now we're moving on to the depletable base, which here I'll go ahead and back up. So we talked about this, now we're talking about this to get the depletion expense. I forget too that y'all really can't see my mouse, but okay, depletable base. The overall objective is to estimate all costs of proved reserves incurred and yet to be incurred and amortize them over the production of proved reserves of developed and undeveloped properties. Apples to apples concept. High level, what does that mean? All of the costs that you've capitalized from inception to date on your proved reserve category wells, so your PDPs, your PMPs, and your PUDs, all those costs need to be factored in because you're factoring in all the production associated with those reserve categories. So in order to be comparing apples to apples, you need to make sure you're considering all those costs of proved reserves. So if you're looking at an oil and gas roll forward, if some of you have already seen these before, you notice that costs are differentiated on an oil and gas roll forward between unproved and proved. So for this calculation, you would exclude the unproved cost and get all of those proved reserves and all of the associated accumulated DD&A up until that point to be factored in to this component into the calculation. So capitalized costs, we're going to talk about a few costs that you would specifically be excluding, and then a few costs that you want to make sure that you're including that maybe you didn't consider before. So what costs need to be included? We're going to touch on 3. So exclude costs incurred on unevaluated, unproved properties. We've already touched on that. We only want to be talking about proved reserves for this calculation. You also need to exclude significant investments in major development projects. We'll get into those in a minute. And undiscounted future salvage value of lease equipment. We want to make sure that we're including undiscounted estimated future expenditures to develop those proved reserves. So if you've got a PD&P well, and there's going to be some future expenditures that you need to incur to get that well producing again, you need to include those costs. Undiscounted, but you need to include them. You also need to make sure you're including ARC, asset retirement costs. There's going to be a whole other segment later on asset ARO, asset retirement obligation. For now, we're going to touch on it high level, but you want to make sure ARC to be incurred in developing proved reserves are included. So in the next couple slides, we're going to go into those a little bit more. So talking about your costs that need to be excluded. So your costs on unevaluated properties. These are the costs that are not associated with your proved reserves. They're evaluated for impairment separately, and they included in the DD&A base when impairment occurs also include G&G costs, which cannot be associated to a particular property. We're not going to get into that right now in a deep dive, but just know, high level, unproved, unevaluated costs are not factored in here. Significant investments in major development projects. So what we mean by that are costs such as drilling, enhanced recovery programs, and other similar costs to ascertain the quantities of proved reserves, i.e. to convert probable reserves to proved reserves. So these are costs that that the company has already planned to incur in order to ascertain if there's proved reserves in the ground. So say the company just lease some property, they're going to incur some costs in order to discover if there is actually proved reserves in the ground or not. That's the costs that are being talked about here. And then you've got salvage value of lease equipment. Again, okay, costs included, future development costs associated with future costs to develop proved reserves. We talked about that. ARCs, you'll learn about that later. But those two need to be included. Okay, other considerations. So y'all can read up on these. But essentially what it's saying is the frequency of the computation, again, is quarterly for public companies and then annually for private companies. But if there's a big change that happens, they need to be trued up. The expense needs to be trued up. Subsequent events should be considered, especially for costs excluded, such as costs of undeveloped properties or significant development costs. So you want to consider that. Any significant subsequent events, you want to consider how that would affect your depletion and impairment. Okay, for your depletion rate, some audit considerations, test assumptions on the reserves. Even if they're performed by a third party, you want to test them. Ensure that only proved reserves are considered. Test the conversion computation for reasonability. And then you want to make sure that the beginning of period reserves are reasonable. Okay, here's some more audit considerations over the excluded and included costs. I'm going to have to speed up here so we make sure we have enough time. But we're going to get into our first exercise. Okay, so I'm sharing my screen with you guys. This is what our first exercise looks like. So if everybody wants to pull that up on their own desktop, you can, or you can just watch my screen. We're a little bit behind, so I'm going to go ahead and just work through this in real time with you guys so you can see what all this means at the end of the day. So, step one, we are calculating depletion for a full cost company, and we need to determine the dominant oil or gas equivalent by converting the production volumes. So we're going to test to see if BOE is the significant unit. So we're going to grab our oil production barrels here, 30. Then we're going to grab our gas production, and we, like it says on the slide, we're going to divide it by 6 to convert that to BOE. Okay, so that tells us we've got 40,000 BOE, which would be our significant unit, given that we have, when converted, 30 barrels of oil and only 10 BOE of gas production. So the dominant unit is BOE. Okay, now moving on, we're going to calculate the beginning of period reserves. So this is one of the first aspects in calculating your depletion rate, right? So in order to calculate the beginning of period reserves, we need two things. We need the ending of the period proved reserves. So what were they at 12/31/2021? And then what was the total production in the dominant unit to be added back? So total production. Let's grab those from above. We've got 12 million BOE at the end of the period. How many did they produce? They produced 40,000, which gives us a total at the beginning of the period of 12,040,000 BOE. Okay, second step. Now we're going to actually calculate the depletion rate. So what do we need for this? We need, again, total production. Then we need the beginning of period reserves. So what did we produce for the period? All the way up, 40. How many did they estimate that they would have at the beginning? Then how much did they deplete in the current year? They produced 40,000 of 12.4 million, 0.4 million. So that means they depleted 0.33% in the current year, or the period. Cool. Depletable base. Okay, now how we calculate the depletable base, these are the cost side of things. So we first need to grab all of the capitalized costs associated with proved reserves, net of accum. So let's grab that. And then we also need to factor in the estimated future development costs that are going to need to be incurred in order to get these proved reserves out of the ground. 25. So our total cost to be depleted is 125 million. Then if we're calculating depletion expense, let's bring it on home. So the first thing you need is your depletion rate. Then you need your depletable base. You go back to that calculation slide, you'll see what we need to do with these two things is we need to multiply them. Okay, so smoke's cleared. We have $415,000 worth of depletion that needs to be recorded for the current period. Now, I filled out this pretty quickly. I'll be sure to send you guys the solution at the end of this, so in case you need it, in case you want it, you can work it through and have the answer. But final answer is depletion expense, $415,000. So how would the company book that? I'm going to stop sharing my screen. Back to the slide. So how would they record it? Well, they debit depletion expense, which is an expense account, of course, for the 415, and then they would credit accumulated DD&A, which is a contra asset account. So getting back to accounting principles, contra asset account would be a credit against the capitalized costs. So that is what the entry would be for the period. All right, ceiling impairment test for full cost method. So general points, you test them for each cost pool. Again, cost pool is set by the country, your cost center. So all of these are piled together and you're testing them and assessing them for impairment as one. Unproved properties evaluated separately. Take them out. They're not considered here. Performed quarterly for public companies and at least annually for private. Common theme. Important note, any write-downs or impairments taken year over year cannot be reversed in subsequent periods. So if they took an impairment in 2020 when things went crazy, they're stuck with it. You cannot reverse it. It's on your balance sheet. Here's the rule, i.e. calculation. You take your capitalized costs of both proved and unproved. That's kind of confusing, but go with me. You subtract out your accumulated DD&A and then related deferred income taxes. Pro tip, never really happens, so we're going to move on from that. Shall not exceed in amount of equal to the sum of these four things. These four things added together equal your cost pool ceiling, which gets compared to the capitalized costs. So the first factor is the present value of estimated future net revenues from proved reserves. So you look at your proved reserves and you take the present value of the future cash flows. So you consider your net revenues. This is all coming off the reserve report. Future net revenues, take away those future expenditures, and then discount it back using a factor of 10 to get the present value. So what are those properties valued at today? That's what that means. Okay, so what are my proved properties valued at today? Plus the cost of properties not being depleted, your unproved or unevaluated properties. So this could be a bit confusing. It was confusing for me too at first. The cost of your of properties not being depleted, i.e. unproved, unevaluated properties. You're adding that to the cost pool ceiling. Okay, so that cost is being added for the unproved properties to the cost pool ceiling, and it's also being added up there at the top in your capitalized costs for your proved and unproved properties. So apples to apples. You add those unproved costs in for your capitalized costs to then be compared to the cost pool ceiling, which also factors in the cost of those properties. Third thing, lower of cost or estimated fair value of unproved properties included in the cost being amortized. That's also kind of confusing. It's a thing, doesn't really happen in real life, I'll tell you. In my 6 years of experience, give or take, I have not seen bullet point 3 or bullet point 4. So we are really going to graze over those, okay? Moving forward into the different components, a little bit more of a deep dive. So these reserves, the present value of your future net revenues from proved properties, are coming off your SEC reserve report, like we established in that question in the beginning. It's the same reserve report that you use for your depletion, okay? And it's calculated using a specific 12-month average first of the month price, which they'll get into later, I'm sure, with reserve report testing. But just know that the SEC established price is what's driving this reserve report. In calculating the ceiling, you exclude plug-in costs, ARC, for developed properties, but include them for undeveloped properties. So, again, it's the apples to apples concept. If salvage value is not included in the reserve report, it should be in addition to the PV10 for purposes of the ceiling test. And then that last bullet point, I've never really seen it, but it's a thing. So if you get in the situation where you're calculating this later on as a part of your audit, then use these slides. They could be really helpful. Companies do things differently, so you never know if it's going to be relevant to you or not. Okay, this is the second bullet point. Again, the cost of properties not being depleted is included in your cost pool. These amounts are evaluated for impairment separately, which is why they're added into the cost pool, and then they're also added into the capitalized costs. So they're really netting each other out if you think about it, because they're getting evaluated separately. But if there happens to be impairment, like if you evaluate them separately and it is impaired, then a special situation happens where you have the value of the impaired unproved property is transferred to the full cost pool, i.e. transferred to the proved property classification and included within the depletable base and ceiling tests. That can be very confusing. I get it. We don't have time to go into it right now, but it's a thing. Keep it in mind and come back to your slides if that is a situation for you where your unproved properties have been impaired. Number 3, again, I haven't really seen it in practice, but it's here for you guys if you want to read it. 4, income tax effects. Same situation. I've never had to consider this in my ceiling pool or ceiling impairment test on the cost pool, but if you do, it's here for you with an example of the 2 different methods. Here's method 1, here's method 2. Here's the journal entry associated with it.
Okay, I wanted to slow down the seminar here to go through the example a bit more thoroughly. What is important to gather from this slide is that the carrying cost of our cost pool is $70 million. Additionally, they have calculated the ceiling before tax to be $39.5 million, and other relevant data is that oil and gas properties have a tax basis of $7.5 million, and there was a PV10 depletion of $1 million. This slide demonstrates a year-by-year method, but is not overly important to our analysis. What is important to gather from this slide is that the ceiling was calculated to be $39.5 million on the previous slide, and we are subtracting the income tax of $6.5 million, which is our tax basis of the properties minus the $1 million of depletion. This is being compared to the carrying cost of $70 million, which identifies an impairment of $37 million. Here are the journal entries. In order to get from the previous slide to here, we took the $37 million ceiling write-down, net of tax, and we reintroduced a 21% tax. That math is $37 million divided by 0.79 to get to a total impairment, gross of tax, to be $46.8 million. The difference is booked as a deferred tax liability. I'll reiterate that the tax method is typically not how you would see this calculation, and it will simply be whatever your PV10 value is over your carrying value. If the carrying value is less than the PV10, then you impair. Okay, let's jump back into the seminar.
And then here's some considerations that I wanted to touch on. Again, include only proved reserves, no probable or possible reserves. Related to the net book value, here's a deferred tax consideration, if that's a situation for you. Consideration of salvage value. Future cash flows associated with settling AROs that have been accrued on the balance sheet should be excluded from the computation of the present value of the estimated future net revenues to avoid double counting. A lot of good info here. There's an exemption. This is actually important. Exemption for purchase proved properties. So if the company has a large acquisition at the end of the year, or, within the current period, you can exclude those proved properties purchased in the year of analysis from the ceiling test if you can demonstrate that the fair value exceeds cost beyond a reasonable doubt. So typically when the company is doing a large acquisition, there's a lot of fair value analysis that happens as a part of that.
Because they're agreeing on the purchase price and all that good stuff. So if they just did that in the current period of analyzing these properties' fair value and making sure that it's a
reasonable purchase price, then we don't need to evaluate it again for impairment, because chances are it didn't decrease that much in value between when the company analyzed it to acquire it and now. So you can probably exclude those. Check out the SEC accounting series to make sure, but for private companies, yeah, you can probably exclude them. So for public companies, though, you do need an SEC waiver for that. So private companies, we get away with more. Public companies, you need a waiver. But something to keep in mind. Okay, subsequent event effects. You can avoid or reduce a write-down if additional reserves are proved up on properties owned at year-end. That's so key. So if the company took an impairment based on activities of the current year, and then subsequent to the current year, they have all these properties that they were able to prove up, well, I mean, it wasn't that long ago, so you should be able to factor those in, right? So you can avoid or reduce your write-down if that's the case. But due to historical first of the month average price used in accordance with reserve rules, you cannot factor any subsequent price increases, which means in practical application that when everything went crazy and oil and gas prices were everywhere during COVID, a lot of companies had to stick with the impairment that they needed to record. Although prices recovered subsequent to that event, they could not factor that in, so they were stuck with those impairments, unfortunately. Audit considerations. So you need to be reconciling all of these inputs. So all the inputs for both calculations, impairment and depletion, you need to be looking at each component and making sure it ties to either the reserve report, the trial balance, or the oil and gas property roll forward. That's key. Before you even get into the pluses and the minuses and the multiplications, you need to make sure that your starting point components tie to something that we've tested elsewhere. Ensure you're proper calculating in accordance with SX 410 rules. You can look that up if you want. The use of incorrect reserve report in the ceiling calculation. So remember how there's 2 reserve reports for successful efforts and 1 for full cost? You need to make sure that you're not using that second one, which is based on different pricing for either test here under full cost. You only use the one. If significant, capital accruals should be split between proved and unproved. Yeah, looks good. Here's a question. How often should the ceiling impairment test be performed? The answer to that question was quarterly. Public companies are quarterly. All right, let's jump into an exercise real fast. Okay, hopefully everybody can see my chats popping up, as well as this exercise. So, again, you guys can download this on your own and check it out, but we're going to have to speed demon through it right now. So, let me pull in my solution. Okay, so one thing I want you to note, straight off the bat, ending net book value of oil and gas properties. This is done by considering the depletion that you calculate on tab 1. So watch me here. So calculated by taking the balance of capitalized costs at the beginning minus the depletion expense that you just calculated. So if you're doing this in practice, depletion comes first. Get your depletion expense, then do your impairment assessment. So watch. You take what the costs were at the beginning, and you factor in what was just calculated as depletion in order to get the net book value to be compared to the cost pool ceiling. Okay? So that's one calculation you need to do right off the bat. But how do you calculate your cost pool ceiling? Well, in this situation, if you're looking at your slides, this is bullet point 1, which is the only things that, most companies consider, you have to consider. So it's your PV10, your future net reserves on all of your proved property categories. So let's just grab all those. Okay, so here's your cost pool ceiling. Boom. So you are going to be comparing your cost pool ceiling to your ending net book value of oil and gas properties. This considers your capitalized costs initially, and then you add in a cum DD&A, and then you add in or subtract depletion expense. So you're factoring in all of that. So now we're going to test for impairment. What do I need? I need the cost pool ceiling, and I need that ending net book value. And then we are going to subtract, just copy and paste this, cost pool ceiling, ending net book value. Okay, so what does this mean in a nutshell? The value that the company expects to get from their properties, i.e. this, is $42 million. But unfortunately, the company to date has net capitalized costs on their books, on their balance sheet, of $49.5 million. So unfortunately, the future value that they expect to get is lower than what's sitting on their books. So lower than what they've recorded as a cost associated with all those properties. So that means they've got an impairment of $7.5 million. Ouch. How is that recorded? That is recorded, back to your slides, everybody, by debiting impairment expense account, and crediting, again, accumulated DD&A, the contra asset account. So what this does is it adds a big expense to your P&L, and it takes away a chunk of the cost on the balance sheet for your capitalized cost under oil and gas properties by that contra asset account.
Just finished talking about full costs for depletion and impairment, and now we're going to talk about the other method, which is successful efforts, but we're still going to cover depletion and impairment just under the other method. So, the next slide. So our agenda, basically we're going to kind of go over the depletion rules and guidance for SE. We're going to talk about the processes related to the depletion calc, the components of the actual calc. Then we'll do a quick case study. After that, we'll move on to impairment, kind of go over the rules and guidance. Specifically for proved properties, we'll do another case study for that. And then towards the end, we'll try to go over impairment for unevaluated or unproved properties. Hopefully we have time for that, but that's also something we can kind of go through pretty quick. So let's skip next. Okay, so for successful efforts, the cost center grouping is either at the individual property or an aggregation property level. And when you aggregate, it's based on the properties having a common geological structure or feature, and usually that's going to be as either a reservoir or a field. This is different from full cost, where they're kind of grouping everything in one cost pool by country. Here it's reservoir or field. Most companies are going to aggregate by field. That's what you'll see most of the time. You might have a client where they might have multiple fields, even though it's the same general play, same area, but they might break things into different fields just on the fact that it might be two areas where they're drilling on different counties, or it might be across state lines, and that can have kind of severance tax implications. So for that company, they might classify everything into different fields, even though it's really, there's no real difference between the reserves in those areas. But that's something you might see. As far as the proved property acquisition costs and proved property well and development costs, which include the related equipment and facilities, these are depleted on a unit of production basis. That's pretty similar to the full cost method. This method matches depletion expense to oil and gas production, so the expense matches with the actual production period. Leasehold and acquisition costs are depleted over total proved reserves, while intangible and tangible drilling costs are depleted over total proved developed reserves, and that's kind of the difference. You're going to have two separate aspects of the calcs, with leasehold and acquisition costs being depleted over total proved reserves, and then the actual intangible and drilling costs, which are also, you can just call development costs, are going to be divided by, or depleted over total proved developed reserves. So that's a bit of a difference. Let's move to the next. Are unproved properties subject to depletion? Simple answer, no. Unproved properties in the successful effort method of accounting are not subject to depletion, but they are subject to impairment. And that's something we'll touch on later on in the slides. Okay, so this is what the depletion calc looks like. You have current period production divided by your beginning period of reserves to get you your depletion rate. And then the depletion rate is multiplied times your depletion base to get your depletion expense. Some of these things we kind of already went over, but I'll just quickly hit them. When we're talking about production volumes, we're talking about the current period production volume. We're talking beginning of period reserves. We're talking about the reserves at the beginning of the year, which the way you get that would be to take your end of year reserves from the reserve report and then add back the production for the period. So typically you'd expect your end of year reserve number to be smaller unless there was acquisitions or something, and then you add back the production to get back to that beginning number. And then for the actual calculation of the depletion rate, you're taking that once again, that production for the period, dividing by the beginning of period reserve basis. Then you take the rate and multiply it by the actual depletable cost basis. This is your actual dollar amount costs that you've capitalized. And once you do that, that equals your actual depletion expense for the period. And yeah, just in that formula, depletable base, when we're using that, we're talking about dollar amount, as opposed to the others where we're talking about volume amount. So if oil and gas are found together, amortized unit per unit generally should be calculated on the basis of the estimated total equivalent units. That was the whole BOE versus MCFE. Unit of production rates are revised whenever the need is indicated, but must be reviewed at least once a year. So public company issuers generally perform quarterly calculations, while private companies, non-issuers, generally perform one annual calculation. For an issuer's calculation, you use quarterly production, beginning of period reserves. For non-issuer's calculation, you use annual production and beginning year reserves. Under the SEC rules, each quarter is treated as a discrete period, meaning no cumulative year-to-date changes in estimate. And just to kind of clarify on that, so if you have a public company and you're doing depletion on a quarterly basis, for those first three quarters, you're probably actually going to be using the prior year reserve report, and then you're taking into account the production for each of those three periods. Whereas when you get to the fourth quarter, you're actually going to use the end of the year reserve report and add back that most recent period of production. So that's a little bit of a twist for public companies. But when you're talking about a private company, you're just going to take your end of year reserves straight out of the reserve report and add back production for the full year to get back to that beginning of year reserves. And going forward, we're pretty much going to do all the examples based on a private company just to keep it simple. All right. So the components of the depletion calc. I kind of just went over what the beginning of period reserves are. We kind of already beat up the equivalent units, so I'm going to kind of move on from that. So your depletable base. So just kind of to reiterate, this represents the total capitalized costs at the end of the period less accumulated amortization. These costs include acquisition costs, which is like the actual cost to purchase, lease, or otherwise acquire the property. We kind of list some of the other types of expenses that qualify for that. It also includes exploration costs. These are costs relating directly to successful exploratory wells, drilling and equipping wells, including exploratory type stratigraphic test wells. All other exploration costs are expense. And here's our very key point. Exploratory wells that do not ultimately find proved reserves are expensed, while successful exploratory wells are capitalized. So if it ends up being a dry hole exploratory well, you're just going to go ahead and expense that immediately. Continuing with that, still talking about the depletable base. This also represents the total capitalized cost, the end of period less accumulated amortization, and the costs include development costs. These are costs incurred to obtain access to proved reserves and provide facilities for extracting, treating, gathering, and storing the oil. Basically, these are your actual development costs. This is going back to the previous slide. We talked about tangible and intangible drilling costs. This is the, to complete the well to where you can actually extract oil. So those kind of costs. So kind of continuing with the components of the depletion calc, kind of reiterating a few things, but only exploratory wells relating to successful reserves and development costs that relate directly to specific reserves are capitalized. Costs that do not relate specifically to reserves are expenses incurred. So that's kind of hitting on the dry hole exploratory cost again. Here's a little bit of a twist. Development wells that result in dry holes. So this would be, they know the oil's there, they're drilling a development well, but something either goes wrong in the engineering of the well, or they get down there and there's been a shift in the layers, or they're just no longer able to access the trap. It ends up being a dry hole, kind of wasted money. Even though that's a dry hole, as it's a development cost, meaning they're trying to get actual reserves, they've already know where they're, that's actually going to still be capitalized. So that's a little bit of a twist. So it's dry hole exploratory cost where it's unsuccessful, aka dry hole, that's going to be expensed. If it's a development well that results in a dry hole, that still gets capitalized. So a little bit of a twist. In the second kind of paragraph down there, it's also talking about some of the other costs you might see, such as kind of work in process, where this is, they're incurring drilling costs to make a well, but they haven't quite completed it, so there's nowhere to actually assign those costs. So since it's kind of in like a work in process category, it just sits there capitalized, but it doesn't actually get depleted. So, okay, auditing. Okay, so now we're going to kind of talk about how you audit the components of the depletion calc. Okay. For testing of the depletion, perform the following. Verify depletion calculation is in accordance with guidance. So that's really like, is it a successful efforts or is it a full cost company? Agree costs subject to depletion, agree to the oil and gas roll forward. So that's where you go to the oil and gas roll forward. You make sure that the right categories are being pulled in. Like we mentioned, you wouldn't want to pull in unproved, and you wouldn't want to pull in with agree current year lease operating statements by production month of revenue work papers. So I'm sure in one of the other sections we'll probably talk about lease operating statements, and that basically just tracks the revenue and expenses for the year on a month-by-month basis. And specifically when you're talking about a production month LOS, that's going to be actuals. So what happens is around production statements typically lag 1 to 2 months at the end of the year before they come in. So the production statement LOS actually takes in the actuals that are going to match up to that, whereas the accounting date LOS, which will agree your GL, typically will actually have accruals in it. Typically, there's not a big difference, but if there is, they might have to kind of reevaluate their accrual process. And then agree year-end reserve quantities with third-party SEC pricing reserve report. So when you when you try to calculate the beginning of period reserves, you need the end of your reserves first. That comes from your reserve report. It says third-party. Only technically public companies are required to get a third-party reserve report. So some of your clients, if they're just a small private E&P company, they might do it in-house, their reserve engineer. Let's see if there's anything else. I think we got all that. Okay, so we're going to try and do an exercise real quick. This is kind of, hopefully you still have that Excel open, this Excel over here where we see the Michael, Dwight, and Jim field. If anyone's not seeing that, please let me know. Because we're kind of running out of time a little bit, I'm probably just going to kind of work this through. But as you can see, it's set up to where the first step you want to calculate your beginning of period reserves. The second step would be to calculate the depletion rate. And then you would take that depletion rate and multiply it times the depletion expense. But for the sake of time, I'm kind of just going to quickly plug and chug on some of these numbers. So let's see. Okay, so let's talk through this first one real quick. So if you'll notice, as we mentioned before, the depletion calc for successful efforts kind of has to be subdivided into two categories. One of those categories, which would include leasehold costs, but it's really going to be acquisition costs, which leasehold costs are a part of, they're going to be divided by total proved reserves. So if you kind of look up to the end of period reserve basis, you can see the two categories, which are PDP, proved developed producing, and then there's proved undeveloped producing. Well, those are still both proved. So for the purpose of depleting leasehold costs, we actually need to add those together, which is where you get the 4 million right here. And then we also need to get to the beginning of year reserve. So that means we have to take into account the production for the year. That's the 100,000 over here in the production section. So your beginning proved reserves for leasehold costs, which would be the total proved, is 4.1 million. Looking at the development costs for the Michael field, where it was just going to be the proved, developed, producing that we're pulling from. So that's why this is only $1 million. If you look back at the end of period reserves, it's the $1 million, but you still have to add back the same production amount. So it still gets added, or the 100,000 production for the period still gets added back to it. So we end up with 1.1 million. You do the other two the exact same way, so I'm just going to kind of quickly drop these guys in. If you have any questions, feel free to hit the chat. And all this, the completed versions of the final answer will be available at the end of the day. So same thing, if you follow the math, we're doing the same thing for these categories. So I'm just going to go ahead and skip down to the depletion rate. And basically what we're doing for the depletion rate is we need to take the production for the period. So let me just grab this. So production for the period, so that's going to be the 100,000 again. And then we divide it by beginning period reserves. So we get this 2.44 and a 9.9 depletion rate. So I'm going to go ahead and just do the other two for us. So that's how you get the depletion rate for all three of our fields. Now let's do the actual depletion expense. So what we're going to do for that is we're going to take that depletion rate that we just calculated above, and we're going to multiply it by our cost basis. These are the actual capitalized costs. So if we go kind of back up to the top, our actual cost basis is this capitalized cost category up here. So try to memorize those numbers for a second. We'll kind of just go through it down here. Not the percentage. Okay, yep. Show that as a percentage. So yeah, as you can see, we pulled the depletion rate from up here for the Michael field, just brought it down here, and then our depletable cost basis for our leasehold costs is specifically, coming from here, and then our development cost, the $12 million, coming from there. And then we divide by multiply by our different depletion rates, and that gets our actual depletion expense for that field. I'll just go ahead and drop in the others so we can tie this back to the slide.
I just wanted to point out, you guys, successful efforts versus full costs. The big glaring differences here are you're allocating between the different fields and the different cost categories. So for full costs, all of the costs are lumped together and depleted together. And there's no fields to consider. It's all lumped into one cost pool by cost center, i.e. by country. So successful efforts is obviously a lot more intensive than full cost.
Yep, and that's a good point. And now that we've gotten, to get to our actual total depletion expense across, company-wide, basically, we just add the depletion expense for these three fields, which ends up getting us that $2.2 million with change. So let's go back to the presentation. And we'll stop sharing for a second. Okay. So yeah, and like I said, I know that was a little bit quick. We can send this all out, and if anybody has any questions, we can talk about it. But basically, if you remember, our final number was 2.2 million with change, and there it is. And you're going to do debit depletion expense, and then you're going to credit accumulated DD&A. Because basically, that's the whole point of that account. You're accumulating a contra asset account to offset the actual book balance of the asset that remains unchanged. Okay, so moving on. Okay, now we're going to get into impairment. So I'll try to go quick. So next slide. Okay, so impairment you need to calculate whenever events or changes in the circumstances indicate that an asset's carrying amount is not recoverable. This is generally performed at least annually for oil and gas companies. Public companies have to do it quarterly. Types of triggering events, list a number. Any one of those could technically do it, but the one that most likely would cause it and would cause it industry-wide is going to be a decrease in commodity prices. We saw that with COVID early 2020. I think oil got down below like $20 a barrel. So pretty much everybody was taking some sort of impairment on that. So that's probably going to be the biggest one. So let's say you did identify impairment. That's the first part of a two-step test. Then the second step would be to actually calculate the impairment you're going to take. So we'll kind of get into that next. So when you're talking about impairment, you have to, the second part is actually figure out the fair value. And that's what you'd actually compare to the net book value to calculate the impairment expense for the period. So fair value is the price that would be received to sell an asset or pay to transfer a liability in a transaction between market participants. For this case, oil and gas properties, it's a level 3 valuation. And basically that's saying is since there aren't really any observable inputs used in the forecast, and when I say forecast, I'm talking about what we call the management best estimate reserve report. Remember earlier Julie mentioned that successful efforts has 2 reserve reports. Well, now the first one that was used for depletion is typically called the SEC reserve report, and it uses SEC pricing, which is basically historical pricing. It's the first day of the month, 12-month average, rolling average. So, but it basically the keyword historical pricing. And then when we're talking about impairment, we use the management best estimate reserve report, and that's using what we call strip pricing, which is a forward price that's based on future contracts that are being closed. I think it's like 12 months out. Takes the average of what those contracts are being sold and bought for, and it gives you kind of a price for the year. Typically, when you get a strip, it's about, you might have like 5 years worth of actual prices, and then it just kind of holds the price from there on constant. And yeah, and like I said, anytime I'm using forecast in oil and gas, I'm really talking about the management best estimate reserve report. Let's see, stock level 3. So generally, yeah, the discounted cash flows method is used as far as coming up with the fair value. Rough rules of thumb, such as value per reserve barrel or production volumes, are not appropriate. So, proved properties impairment method, or sorry, fair value considerations. Keep going. Properties commonly are grouped by field. That's the same as kind of DD&A. Prices, I just kind of went over that. The management best estimate reserve report, you just strip pricing, just think future pricing. And when you do actually get in a situation where you're testing the management best estimate reserve report, one of the things you might do is to get an independent strip to compare to what the client's using. And to do that, you can just reach out to the BDO valuation guys and just say, hey, I need a strip as of 12/31, whatever the year is. And then you want to say, if you're dealing with a client who's in West Texas, they're probably on their index they're using is WTI. If they're overseas in Africa or that side of the world, it's probably going to be Brent. So you just tell them, I need the Brent strip as of 12/31. Okay. So talking about reserves, another slight difference between DD&A and impairment. So when we're talking about DD&A, the reserves we're using are what we call the 1P, which is just approved reserves. However, when talking about impairment, you're actually able to take into account what we call probables and possibles, and use what we call a probabilistic reserve approach. It basically means like there has to be at least a 50% chance or greater that you will recover the amounts of the 1P, which is the pre-reserves, and the probables, that the projection, you have to get at least 50% chance that you can actually get that recovered. And then possibles uses a 10% threshold. Let's see, let's move on to the next one. Or actually, and then, yeah, as far as the cost running, they're going to be pretty similar between the two reserve reports. Not going to be a lot of adjustment there. Income taxes, unless you're dealing with a public company, it's probably going to be severance taxes more so than income taxes that we're dealing with. So let's skip ahead. ARO is not included in future cash flows as the costs have already been increased for ARO. Discount rate. So this is another thing that might be a little different between the DD&A and the impairment reserve reports. Usually in the DD&A reserve report, the SEC pricing reserve report, you're going to have a discount rate of like the normal PV10. That's not really related to fair value. So typically a fair value, present value rate is going to be something more like credit adjusted discount rate, kind of based off your weighted average cost of capital, something like that. That's getting a little more complicated, but so yeah, typically your PV10 would not actually be a representation of fair value for the purposes of impairment. And then, yeah, derivatives cannot be taken into account in determining fair value. Hedge accounting, I'm not even going to try to touch on that. So here's a quick proved properties impairment example. Let's keep it simple. So you have field A, field B, field C. Our undiscounted future net cash flows are $5 million for field A. We have a net book value of $4 million. Is it impaired? No. We look at field B, similar situation, not impaired. But then we look at field C, and we actually have a net book value above our future cash flows. So yes, it's impaired. Step 2 would be to actually calculate the impairment. They're just kind of giving us the fair value. So you take the 12 minus the 7, you have a $5 million impairment. So yeah, here would be the entry impairment expense. This does hit accumulated DD&A, as we're actually hitting, proved properties have an accompanying accumulated DD&A account. When we get to unproved properties, you'll see you can't do that because there isn't accumulated DD&A for it. And if it's a public client, you might actually have tax implications where you need to actually record some sort of deferred tax asset. And basically that's just, the difference between the net book value, the new value and then the tax basis value. multiplied by the assumed tax rate. And that's basically what's happening here. Putting the deferred tax asset on the book and then hitting the tax provision for the benefit. So let me just keep going. So yeah, this is kind of talking about issues we've had in the past, numbers not tying to schedules and financial statements. Probables and possibles may be included, like I said, for when we're talking about impairment, they can, but you have to use one of the methods of either applying some sort of, like, not necessarily discount factor, but adjustment factor for the fact that there's more risk when it comes to probables and possibles. They might not actually be recovered. PV10 may not be appropriate. We already talked about that. Salvage value should be deducted. Often, yeah, it's not shown in the reserve report. And then plug and abandonment costs should be included for undeveloped wells only. So, sorry if I'm going fast, but we have a handful of slides left and not much time. Approved properties, impairment. So, I mean, yeah, we've kind of already talked about all this. Basically, it's hitting on the fact that we're going to use the management best estimate reserve report for impairment. But if there's a situation where you actually have rising prices, you could use the SEC reserve report for the step one. But if there's decreasing prices, you'd have to use the management best estimate, which uses the future pricing, because if you didn't, there's a good chance you would actually miss the impairment that would be hidden there. So that's kind of what that's saying. Keep going. Case study. Let's just do this really fast. Let me share my screen. So I'm hoping you're seeing this. So basically, I'm just gonna do this one as well, but try to follow. So up here we have our actual cost balance, then we have our undiscounted future cash flows and our discounted future cash flows. So just plug these in. First step, we compare the book value to the undiscounted cash flows, and it looks like in the first case, our book value is lower than the undiscounted cash flow, so not impairment, or not a triggering event, I should say. However, in the other two cases, it's the opposite, where book value is actually higher, so we do have a triggering event. So let's go and calculate. I'm sorry. Okay, so I just pulled the discounted cash flow number. That's just coming straight from over here. You can kind of see both, the first set of numbers went to here, second set of numbers went to there. So we look at the calculation, and for the two that we had a triggering event, we happen to calculate about $8 million worth of impairment for each one. So that's a really simple example, but you kind of get it. Let me go back to the presentation. And stop sharing.
So again, differences here is it's separated by field, and there's 2 steps. Full cost, 1 step, successful effort, 2 steps.
Yep, and then here's our entry for it. We combine it, so the full impairment expense would be the $16 million, the $8 million, plus the $8 million, and then it's hitting accumulated DD&A for the balance sheet side. Okay, let's keep going. All right, now we're getting into the unevaluated properties. So basically, high level, this is typically unproved acreage. It's acreage they would acquire because they believe there might be reserves there, and they intend to prove it up, which means once they actually prove the reserves are there, they can move it to proved property. It may also contain unused field equipment, cash calls, unproved wells. It's excluded from the costs that are subject to DD&A, so you're not depleting it. It can only be assessed for impairment, but it will not be depleted. So when we're talking about unevaluated properties, we kind of have 2 general categories: significant and insignificant. Significant properties are assessed on a property-by-property basis. There's not really a set definition for what counts as significant. It's more so going to be some sort of company policy. They might have a floor for what they'll look at or what they'll break up as a significant property, and then everything else they might just group together as insignificant properties. Okay. So our impairment considerations, property would likely be impaired, for example, if a dry hole has been drilled on it. That's, a great indicator that there might be, the reserves you're hoping were there aren't there. And if it leads to the firm deciding, we're not going to keep drilling here, we're done, that would definitely lead to impairment. Also, the likelihood of partial or total impairment of property increases as the expiration of a lease term approaches. if drilling hasn't commenced. So basically, when the company first acquires the lease, there's usually a term. If they get to the very end of the lease and they haven't drilled anything yet, they're going to have to either pay delay rentals or something to extend it, or they're basically going to abandon it. And once that decision is made to abandon it, it becomes impaired. If the company has definite plans to drill in the lease, such value might be equal to or greater than the book value, so you wouldn't have impairment. Drilling is somewhat likely. It might be less than the original cost. It could be impaired. If you have no plans, it's definitely impaired. Kind of already talked about. I mean, this is for insignificant properties where you might. This is still for individually significant properties. As far as like information that becomes available after the end of the period covered by the financial statements. So, like, let's say we find something out after the balance sheet date of 12/31 that kind of proves that that property really was impaired. If it's before the actual report date, we still need to factor that in and reflect the impairment of those properties. That's basically what that's saying. Company may have a policy to recognize partial impairments time lapses. So if you have a particular acreage, maybe part of it's not going to be drilled on, but the other part you still have potential hope that you can get reserves out of, you might only partially impair the property. And like I said, lease terms, drilling plans all play into that. Let's see. Okay, I've hit 12. I'll try to wrap that up as soon as I can. So still talking about the value of properties. When it comes to actual impairment, you're going to record impairment to a valuation allowance because, as we said before, unvalued properties are not being depleted, so there isn't an accompanying accumulated DD&A account to put it to. So that's why you'd actually have to create some sort of valuation allowance. That's when you're first identified as impaired, and then on the actual abandonment, if there's been even more impairment, you'd have to record that and then write off the actual allowance that you have and clear the original cost basis out. And we'll kind of go over that in the next slide. So as you can see, you have like these 4 leases, and let's see, lease A is impaired by 50, lease B and D are not impaired, and lease C is impaired by 100. Let's go to the next slide. So so the initial entry for impairment would be the 150 that we talked about. You're putting it towards an allowance. That makes sense. Now we're going to assume A and B are abandoned. So I think A had an impairment, so that's the 50 that we're clearing here. And then the impairment of unproved properties that we're debiting right here is 550. That's going to end up being the 400 net cost basis for lease B plus the new value of 150 for A, which gets you to 550 when they're combined. And then you're crediting unproved properties for the full 600, which would be the original cost basis. And like I said, we'll have these slides, so you can always look back if we're going a little too fast. And then here's a kind of a good little calc. We have a group of insignificant properties with cost of $2 million and an average 3.5 year lease term. The company's estimating, so it's a policy to try and estimate when leases, as leases are expired, which ones are not going to get drilled. They're saying 70% of the leases will expire unused. So what do? You would take the 70%, you multiply it times the $2 million, and then you would divide by the 3.5 per year, which I promise you gets you 400,000. And you debit impairment on unproved properties, and then put 400,000 to some sort of allowance. That's where the credit would go. Okay. So these are typical issues. We've kind of talked about all of them. No intention not impairing when you have no intention for further drilling. Costs not being properly transferred between from unproved to proved, and then abandonments subsequent to the balance sheet date. Still might need to be factored in for impairment as long as it's before the report date. So skipping past that. These are just kind of red flags and things to consider when talking about unevaluated impairment. You can kind of look back at this whole list. It's kind of comprehensive.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.